So real estate investors got lower tax rates, probably a lower threshold before they start paying taxes, increased depreciation for improvements. You can take those write-offs faster, and potentially this 20% deduction, we'll have to see how that shakes out.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 112. I am sitting here at the RPOA annual conference with Duane Culver. You might hear some noises in the background if you're listening to this on the podcast. That's because we're at the annual conference. It's been a great one, and we get quality people here like Duane Culver, who many of you might remember I talked to last year. Duane is a CPA.
I'm a CPA here in Grand Rapids, and I also invest in real estate.
And your company is Culver CPA Group.
Yes.
And you're kind of the RPOA's go-to guy for tax questions and
they
CPA type stuff.
They do send a lot of questions to me, and I teach a tax class for them.
Yeah, you teach several tax classes, actually. I thought it would be beneficial to our listeners, with seeing as how we're in tax season and people are probably preparing their taxes as they listen to this, to talk about the new Tax Cuts and...
The Tax Cuts and Jobs Act.
The Tax Cuts and Jobs Act that was passed recently by the Trump administration. The big questions are, what does that mean for 2017 that people are preparing their taxes for now? And what does that mean going forward for 2018 and beyond? So why don't you just kind of take it starting with 2017?
Okay, for 2017. Actually, just this last week here in February, Congress passed another law for the law affected education deductions. It made that retroactive for 2017 as well. So even though we're well into 2018 now, they've reinstated the education deduction for people that would qualify for that. If they're not taking the credits, they may be eligible for deduction. And so that's been reinstated. So that's a very recent change.
Wow, I'm sure that makes your job easier. Any more changes coming down the line?
So we'll see. You never know.
Right.
But for the bigger law change that we're more familiar with and have heard more about, most of the changes affect 2018 going forward. Actually, a lot of them are just for 8 years, 2018 through 2026. After that, the law expires or sunsets, and the rules go back to the way they were before the law was passed. But there's a few provisions that affect 2017, specifically for business owners and real estate investors. And those had to do with depreciation. So depreciation is a process of writing off the cost of a capital investment. So you buy a building or make a major improvement to a home or a building, and you'll write that cost off over a period of years. If it's residential property, usually 27 and a half years. Non-residential property, we're talking real estate, would be 39 years. If it's not real estate but personal property, which could be flooring or cabinets or appliances, that's a type of property called personal property, and that will have a shorter life of 5 years, or in the case of cabinets, 7 years. And so we'll write those improvements off over 5 years or 7 years. But we've had what we call bonus depreciation. So instead of taking the whole amount and deducting it equally over 5 years, and it's not equal anyway because we use an accelerated method, but that gets complex. But we have this bonus, and up until September 28th, when this law was passed, we had 50% bonus, which would allow us to deduct 50% of the cost of the improvement for personal property, not for the real property. 50% of the cost could be deducted as depreciation for the year of the improvement. The remaining 50% we would depreciate over the 5-year life or 7-year life or whatever it was. Beginning September 28th and going up through December of 2022, we can take 100% bonus. So we can effectively write 100% of the cost of personal, if it's personal property, 100% of the cost in the year that we purchased that property and place it in service.
So you're basically depreciating it all within 1 year?
Yes.
Is that the same as like if you were to just expense it for that year?
It had the same effect.
Same effect.
Yes. Yep. So that's for property placed in service September 28th and later. Property placed in service before September 28th would qualify for a 50% bonus.
Was that in place because of Trump, or was that always there?
That's been in place for a number of years. The amount of bonus has been changing, shifting. It's been being phased out. It was being reduced. But now, to encourage people to invest money, spend money, they've increased it. Kind of give us an incentive here for a few years.
So it's kind of goosing the economy by getting people to invest. They can write it off the year that they invest it.
Right.
And hopefully people buy more stuff. Is that kind of the idea?
That's the theory.
Mm-hmm. Okay, so that's one of the changes that people need to be aware of now. If they bought something and put it into service after September 28th, then they can write it off in full for 2017.
Yes. Yep.
If they bought it before September 28th, then it sounds like they can take the bonus depreciation of 50% and then amortize the rest or depreciate the rest over, what is it, a 5 to 7 year period?
It's going to depend on the type of property, because we have 5 years, a very common class. Some of it's 7, some of it's 10 year, depending on the type of equipment or
and this would be for
whatever
equipment, not necessarily for a rental property that you would buy.
But some of these things do qualify in rental property. So that's why I mentioned flooring or cabinets.
Okay.
Appliances.
So capital improvement type things.
Yes. Yep.
Right. But if you buy, let's say I buy a four unit or a multifamily, what is the depreciation schedule on that? Has that changed at all?
That's not changed. So that's real estate.
Right. So
under
real estate itself.
Real estate, those rules would be, if it's a residential real estate, so space where people live, would be 27 and a half years. Anything that's non-residential is 39 years. There are some special purpose classes for special purpose buildings that have a shorter life, but the general rule is it's going to fall in one of these two classes.
Okay, but it's good to know that if you're putting improvements into your property, you can write the cost of those improvements off, quite depending on what they are, in the year that you're.
It depends on what it is.
It depends on what it is.
Right.
So you need a good CPA to help you figure that out.
That helps. It can help. One other area that still related to depreciation that goes into effect beginning September 28th is Section 179. Section 179 is a deduction that's allowed to expense those improvements in the year that you've made the improvement. Actually, it's really for the acquisition of personal property. So the deduction generally doesn't apply to real estate, generally only applies to personal property like the appliances or cabinets or flooring or other things. The other restriction with Section 179 is it only applies to a trade or business. So often for real estate investors, the real estate activity is considered property held for the production of income, not property held in a trade or business. So often it doesn't apply. But if you have a business and your business rents a building from you, there are cases where some of these improvements, the business may be able to write off if the business is making the improvements. But if you as the landlord are making the improvements, you're going to have to depreciate that over a period of years.
So that would mean you have to really have a strategy in mind when you purchase these things to determine who's going to buy it, your business or your real estate.
Yes, yes. So because a business can claim a Section 179 deduction, but an investor cannot. So, and categories that now qualify for under Section 179 now include, if it's a real estate improvement, a new roof, a new heating, ventilating, air conditioning system, a fire suppression system, and a security system. So those can now be Section 179 deductions for a business, trade or business. A real estate investor doesn't get that same deduction.
Wow. So you really have to think that through if you're going to make that major expense. Who's going to pay for it? Your
Yes.
business or your real estate?
Right.
And maybe, a lot of investors, you may not have that choice because if you own a 4-unit and you're putting a new roof on it, like how would you have your business pay for it as opposed to
Right, because
paying for it through your
when
real
you say
estate investment?
4-unit, I'm thinking of a residential building.
Yeah.
Yes. Whereas, if it was a facility where you had a business running out of the
Like
facility.
an office building or something.
An office building or,
Industrial building.
industrial building, whatever it is, then that business could potentially take that deduction.
Yeah. Yeah, you definitely, when you come to those crossroads where you have to make those decisions, you got to have a expert on your team who you can call up and say, I need to put a new roof on my industrial building. How should I do it? Who should pay for it?
Right.
Yeah.
Yes.
But it's good to know that that's one of the considerations. 170. What is it called?
Section 179. Yes. And they've also redefined some categories of real estate that could qualify for Section 179. And that is the improvements to the interior of a building. As long as it was improved, it has to be non-residential. And it cannot be improved at the same time that the main part of the building was constructed. It must be placed in service sometime after the building was first placed in service. The interior improvements are placed in service later. It cannot include redoing the structural framework of the building or elevators, but those improvements will probably in 2018 have a 15-year life instead of a 39-year life, and also potentially be eligible for Section 179 if you're a trade or business. The 15-year life would qualify for both investors and for business owners. So that there is a bone there for.
Yeah, so that's good. So
if you as a landlord, it's a non-residential space, but you remodel the space for a tenant, and the tenant moves in, you would now be able to write that off over 15 years instead of what it used to be, 39 years.
Okay, so that accelerates your depreciation there. Allows you to write off more each year against your income for at least 15 years. After the 15 years, then run out of depreciation.
Right.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com.
Well, first of all, is there anything else that people need to be aware of for 2017 as they're doing their taxes right now?
No, I think that those were the main.
And it sounds like they're like they just made a change last week. So if you're using TurboTax or Quicken Tax or whatever, that's probably not even in the program yet.
Usually the software companies are pretty quick to update their programs, and I think the IRS already is even ready to accept returns and process returns,
Okay.
claiming that deduction. The deduction was in place in prior years, so it was a change for it to no longer be there, and for them to go back and plug that back in, I think was probably not a big hurdle for them.
So
They probably
wasn't
had
as big a deal to keep up with the government as
and
I'm making it, huh?
may have been aware that it was going through committee and so forth, and they may have anticipated this was coming and planned for it.
Okay. So what changes then can real estate investors look forward to in 2018 and beyond?
The first change affects everybody, and that's that we've had a drop in a lot of the tax rates. The very first bracket of income, I guess the place to start would be to look at taxable income. So often when we look at taxes or think about taxes, we think of adjusted gross income. So when you look at a tax return, the front page of the 1040 form, the top portion of it has a list of all your income. It comes down and has gross income. Then there's certain adjustments we make to that. So you could contribute to an IRA maybe, or to a health savings account, or have the education deduction, and various things that we're allowed to make adjustments to that gross income. At the bottom of the page, we have adjusted gross income. And that's a reference point we use for a lot of different things. But on the back side, then we take an adjustment out for a standard deduction or itemized deductions, whichever one you qualify for. Then from there, we usually deduct your personal exemptions and dependency exemptions. And then after that, we have taxable income. So a lot of times people look at the tax brackets and think, oh, my income is this, where do I fit in the tax bracket? Well, the tax bracket's going to be based on taxable income, which is after all of the deductions. So one of the first changes then is, how do we get to taxable income? And they've taken away the personal exemptions and dependency exemptions. So we no longer have those, but the standard deduction has been raised. So for a married couple, it's now, for 2018, going to be $24,000, which is higher than the standard deduction plus 2 exemptions for 2017.
So standard deduction is if you're a married couple, and right off the bat, the first $24,000 you make as a married couple, you don't have to pay taxes on.
Right.
You're deducting that amount from what you have to pay taxes on.
Right.
So if you're a married couple making under $24,000, you don't have to worry about taxes.
Pretty much, income tax.
Income tax.
And it's federal income tax.
Mm-hmm.
States have their own tax
They have
rates
their
and
own
laws and
formulas.
thresholds, and so you'll pay, certainly here in Michigan or locally in Grand Rapids, the city is going to have the lowest threshold. You'll start paying taxes to Grand Rapids sooner than you'll pay to Michigan or on federal. And Michigan would come in place after that, and federal has the highest thresholds when you start paying. But, city has the lowest rate. Mm-hmm. And Michigan's rate is certainly much lower than the federal rate. So, yes, they have their own filing thresholds. And if you have business income, you could be paying Social Security taxes or have, some other things that affect your tax. But for income taxes, you're right. The first $24,000 for a married couple is tax-free, and it's half that number for somebody that's not filing married, if they're filing
Single
single
person.
or head of household. Actually, head of household is going to be 18,000.
Okay.
So instead of 12.
So if you're a single parent or,
Yes.
okay.
If you have a dependent child in the household, yeah, you get the
so both
18,000.
Both, what were they raised from? What were they last year?
So we call it a filing threshold. So if your income is below the 24,000, you wouldn't have to file in theory for income tax purposes. So for 2017, the filing threshold is a combination of the standard deduction and the personal exemptions. So in 2017, for a married couple, the filing threshold is 20,800. 2018, it's going to be 24,000.
Okay.
So it's an increase, even though we've lost the personal exemptions.
That's a 20% increase.
There's still a pretty good increase. The person that loses would be the married couple that itemizes deductions, has deductions. If they're itemizing already close to that 24,000 or above, that family's not going to get the personal exemptions that they were getting before. So they'll get 24,000 or their itemized deductions, whatever they actually are, but they'll not be able to add personal exemptions to it the way they have before. Congress is trying to simplify the tax law in the sense that fewer people will itemize. More people will claim standard deduction because they're raising that number up. So that simplifies things for families. Doesn't necessarily simplify the law, but it'll simplify the compliance for some people, certain group of people.
Okay. Okay.
So that's, when you talk about tax simplification,
there's winners and losers.
That's an example of where, they'll claim it's simpler, and it will be simpler to comply for some people, but the law really hasn't become simpler.
Okay. So that's one of the changes.
That's one change. That's a starting point of when do I file taxes. So then we look at that taxable income number and, what is the tax rate? So the first, close to $19,000 is taxed at the rate of 10%. And that rate has not changed. The numbers have grown a little bit. Every year, the income numbers for the tax rates are indexed for inflation, so they grow a little bit. And we see that's true in 2018. For the next bracket, from approximately 19,000 up to, in 2018, it'll be a little over 77,000. Instead of 15%, the new bracket is 12%. From that up to...
So if you make $77,000, your tax bracket is 12%?
So this is taxable income, so it's after deductions.
After
so you can have
deductions.
income up to 100,000 if you're married.
But once you take the deductions.
Right, taxable income of 77,000. The first 19,000 of that would be taxed at 10%, and the portion above that, up to $77,400, would be taxed at 12%.
Okay.
And then if the income goes above that, the next bracket is 22%. It used to be 25%. So, and that, up to 165,000. And then we see the next bracket up, used to be 28%, and that's now 24%. And that goes up to 315,000. Then, brackets are 32%, 35%, 37% beyond that. And those brackets have been spaced out, so you reach higher income levels before you move to the next bracket than under the former law. So,
okay.
we've seen some rates adjust. Now that's for married. For single, typically the income brackets are half. They just cut everything in half before you move to those brackets. So instead of 19,000 For a single person, it's the first $9,500. That's taxed at 10%. And for them, it's going to be $38,700 is the cap at the 12% rate. So we've seen the rates, the 15% bracket drop to 12%, the 25% bracket drop to 22%, 28% bracket drop to 24%. The higher brackets didn't drop as much, but they've spaced out when the higher brackets apply.
Right.
Yes.
Okay.
Yeah.
So that's that seems like that would create quite a bit of tax relief for people.
It does. It does.
Okay, so it bears out in reality.
So-
Like people are saving quite a bit on taxes then.
So in February, the new tax tables should be applied. So people that are earning wages should have seen a little less federal withholding withheld because of these change in rates.
Wow. What about the taxation of LLCs? Because a lot of real estate investors own their properties through LLCs or have their business in LLCs. What does the tax plan mean for LLCs?
An LLC is a latecomer to the game in the world of business and taxation here in the United States. They came about in the 90s. States started passing these LLC laws, and they're trying to get the legal protections, legal characteristics that corporations had, but they wanted the tax treatments that a partnership had. So that's the goal of passing the LLC laws. And instead of creating a new tax structure for an LLC, the LLC has to fit one of the other existing tax structures already out there. So a single member LLC is taxed as a sole proprietorship, and it's ignored pretty much for tax purposes. Pass through completely. A multi-member LLC is treated like a partnership. And still the income passes through to the personal return, just allocated among the members, and has the flexibility that partnerships have. But an LLC can elect, if it likes to, it can elect to be treated as if it was a corporation or an S corporation. So there's nothing specific for an LLC, that's changing. But one of the big changes for a small business is a 20% deduction that's allowed now. In the past number of years, we've had a Section 199 deduction, and that was a deduction for building things and manufacturing things here in the United States. So a business could qualify for that deduction, deduct 9% of their profits from that activity before it's taxed. Under the new law, that one's gone. We've replaced it with a 20% deduction, but it covers a broader range of people. Almost any business can qualify, with a few caveats. Almost any business can qualify, except corporations. So, and that's a C corporation. So an S corporation will still qualify because this deduction is on the personal return. So an S corporation, the income passes through to your personal return. A partnership, the income passes through to your personal return. And if you're an individual and own a business, that income's on your personal return. And all of those can qualify for this deduction. Even a trust or some of these other things that could have business income, when it hits the personal return, can qualify. So the 20% deduction is 20% of the profit of the business or 20% of your taxable income, whichever is less. You can claim a deduction for that, as long as your income is less than $315,000. If that's for a married couple, the threshold is half that for a single person, so that's $157,500. And if your income is over that level, there's a couple new requirements that get established in there. One is certain industries don't qualify. Another is we have some limitations on the deduction for, limitation that's limited to 50% of the wages the business pays. So, a quick example, if we had a business that has $100,000 in profits and they want to take a 20% deduction, the deduction would be 20%. And that would get calculated into the return, take that 20% deduction, as long as their taxable income was at least $100,000. But if the overall income, maybe that's, $100,000, they would qualify for that. But if the income was $500,000, they would potentially qualify for a 20% deduction of $100,000. But if it's limited to 50% of wages paid, they would have to be paying wages of $200,000 in that business to still qualify for a full $100,000 deduction. If the wages paid were only $100,000, they would only qualify, 50% of that would be $50,000. Instead of getting a $100,000 deduction, they'd only qualify for $50,000 deduction because that's 50% of the wages paid.
So as far as real estate investors are concerned, this would apply to you if you have a management company or something.
So it'd be, yes, a management company would be a trade or business. This deduction applies for trades or businesses. There's a question about whether or not it would apply to real estate business, because normally with real estate, it's not considered a trade or business. This property held for the production of income.
Right.
But there was another provision added to this law shortly before it passed. In fact, it's created some confusion just in how it's worded and established in there. But it's related to that 50% of wages, because most of our real estate businesses don't pay wages often. So there's another provision, and that's 25% of wages, plus 2.5% of the unadjusted basis in my property. So that'd be 2.5% of the cost I've invested in that property. So if I have a real estate building that cost me $100,000, if it produced $10,000 of income for me, 20% deduction on that would be $2,000 if we qualify for the deduction.
If you're paying the wages that meet the right threshold, right?
Yes. If we otherwise
if you have employees,
if we otherwise meet
like
the criteria,
20%.
Right.
But if you don't have employees,
how do we get the 20%?
Yeah.
So the alternative calculation would be 25% of wages, which is still zero, plus 2.5% of the unadjusted basis in the property. So 2.5% of my $100,000 building would be $2,500. So if I qualify for a $2,000 deduction, that would be limited to the $2,500 basis number, and I would still qualify for my $2,000. Now, we think...
So that's a nice little bonus.
It could be, yes. We think that this may actually apply to real estate investors because this is a new provision in the law added late in the game, specifically geared toward businesses that are not paying wages, but instead are capital intensive.
Mm-hmm.
And under the prior law that's this whole law replaced, prior code section, the focus was on business profit limited to 50% of wages paid. Under the new law, we have this new provision now. So if it's capital intensive, I might still be able to qualify for the deduction if I don't have employees. And the former law was the law didn't change based on income or have income limitations in it. The new law has these income limitations. So even though we talked about the 2.5% of basis in the property, 25% of wages, or the 50% of wages, all of those rules only apply when the profit or my taxable income is above, for a married couple, $315,000, or for a single person above the $157,500. If I'm below that, I don't have those criteria. I can just use the flat 20%. Certain industries or types of businesses also are disallowed if the profit hits that 157.5, or for a married couple, the 315,000.
Most of our listeners are going to be real estate investors.
Yes.
Small to medium scale. Maybe let's say they have an 8-unit and their profit for the year is $50,000 and they own the 8-unit in an LLC.
Right.
Are they able to take, if their profit's $50,000, are they able to take 20% off of that and then just pay taxes on the?
I'm hoping that that's true. Mm-hmm. We don't know for sure
yet. So it hasn't been tested yet, and there's no clarification yet.
The law refers to a trade or business. Real estate is usually not considered a trade or business, but they've added some provisions in this law that make it appear they might be trying to make this law benefit people that own real estate, real estate investors. So we need to wait for further clarification, whether it be from Congress or, I think if we leave it to the IRS, they probably will take the position that it's not a trade or business.
Then who would it be for?
We're going to see.
The question is who would
we
it
have to
even be
dig
for?
into some of the committee reports, to see what Congress intended with some of this, or maybe there's some other provisions in this law that need to be corrected. Call them technical corrections. And so we should be expecting to see some of those come out, and maybe that'll get addressed. I don't know.
So it really seems like, aside from the accelerated depreciation that you can take on some of your capital improvements, it's still unclear as to how this tax law affects real estate investors. There's a good chance that it's given them an additional 20% deduction from
I'm
their
hoping,
income.
Yes. Yes.
And we're hoping.
Yes. But we don't know for sure
We
yet.
don't know.
Yes.
And whoever
Right.
put that in the law didn't really make that clear.
Right. The law is not clear yet.
Okay.
Because it refers to a trade or business. Normally, this would not qualify. But yes, we have some indicators that make it sound like, well, maybe this was supposed to apply.
So by next year at this time, will we have clarity? Will we know? Or will people still be guessing? And
I don't know. I would expect we'll get some clarification from Congress, before next year. If nothing comes from Congress, we can see what the IRS position, what their interpretation is. At face value, if we don't hear anything from anybody, I think it would be difficult to say that they're a trade or business and qualify.
mm-hmm. So if they got audited by the IRS and tried to argue, it would have to be tested. Someone would have to argue in front of the IRS.
If Congress doesn't clarify it, I'm sure it will get tested.
Yeah. What else do real estate investors? Yeah. What else is there for real estate investors in this new tax plan?
The depreciation and this 20% deduction are kind of the big things I wanted, to discuss or bring out that affect small business owners and real estate investors.
So some are there other things too then that you wanted
The other things really are, things that affect individuals.
Mm-hmm.
We talked about the fact that you lose your dependency exemptions. And the best way to kind of illustrate what happened here is if you think about the dependency exemption was a little over $4,000.
So like if you had 3 kids, you could deduct $12,000 because you had 3 kids.
Yes.
Okay.
If you're in a 25% tax bracket, that would reduce your income by $12,000 and save you $3,000 in taxes. 25% of the $12,000 total, or $1,000 for each child. What they have done is they've raised the child tax credit by $1,000. So a tax credit, a credit of $1,000 reduces your tax by $1,000.
Okay.
Whereas, a tax deduction, a deduction reduces your income before we apply the tax
Reduces the
rate.
amount you're actually taxed on.
The credit reduces the tax.
Okay.
So they've taken away the personal exemption deduction, but given us a tax credit. And so this tax credit went from $1,000 up to $2,000. So they did give us that. The credit does phase out when your income is over $400,000 for a joint or $200,000 for an individual. The credit begins to phase out. But the credit only applies to children who are under the age of 17. So if your child reaches age 17 during the year and up through college age, if they're still going to college, instead of a $2,000 credit, they may still qualify for a $500 credit, but it's a dramatic loss in the amount of credit there for that child.
Sure.
Yep.
Is there anything to offset that if you have college-age kids who are going away to college?
The only thing to offset that for college-age kids is the credits related to the tuition cost, the education credits that are available.
Has
out
that
there.
changed at all?
No changes to that this year that I can think of. The education, there's an education deduction if your income level's too high to claim the credits. You might qualify for the education deduction, but that gets phased out as well depending on your income level. So it just, those credits, the credits are really nice and really helpful. There's limits on them, but, depends on your income as to whether or not you qualify. And
Why don't we sum it up for real estate investors then? What's in this new tax plan? I mean, as a real estate investor, once
Okay.
again, just kind of like give us the cliff notes
Sure.
on what they get out of
What
this.
did they get out of this? So real estate investors got lower tax rates, probably a lower deduction before they start paying taxes, a lower threshold before they start paying taxes, a increased depreciation for improvements. You can take those write-offs faster, and potentially this 20% deduction, we'll have to see how that shakes out. Those are the kind of the big things, key things.
Yeah, 20% deduction seems like it could mean a lot of money in people's pockets if
Yes.
if it is a real thing.
Right.
Any other recommendations? Like how should people think about these tax laws going forward and applying them to their real estate investing?
Great question. There's always uncertainty in what the tax law is going to be because Congress changes it so often. This law is passed really with 8-year application. A lot of the provisions apply for 2018 through 2026. It's a good time to make certain improvements and investments in the property from the perspective that I can get my depreciation deductions fairly quickly. Another way to look at it, an alternative approach, is this is because of the lower tax rates, these are good years to claim the income. And because we don't know what it's going to be beyond that. And tax rates could revert back to higher rates. They may extend it. It's hard to know. But these might be good years to try to have income. Economists are suggesting these will be economically fruitful years for a lot of people.
If you're looking to sell a property, has your tax position changed at all in that regard?
If you're selling a property, The capital gain rates have stayed the same, and actually the brackets where the income falls are still under the old rules. So the brackets get indexed for inflation, so they've adjusted a little bit, but the brackets have not followed the new tax rate brackets for 2018. So if you're in the lowest bracket of 10 or 10, or the new bracket of 12%, generally a capital gain is taxed at 0% if it's a long-term gain. Above that rate is going to be taxed at 15% until you get up over 400,000. For a married couple, it'd be 479,000. Single person, 425,000. Once you get above that level of income, the capital gain rate goes to 20%. So from a capital gain perspective, these are still good years to sell property, recognize those gains, pay the taxes, at relatively discounted rates.
Okay, so
we don't know that those will be phased out, but you never know when Congress will change things. They've been on a path of reducing taxes for quite a few years. We've seen the taxes fall. Sometimes they bump back up a little bit, but that's been the pattern. And someday the tide will turn and it will go the other way.
Well, what about the Obamacare premium on selling property? Like there was a additional 3.5% or something through Obamacare when you sold a property. Is that still in place?
That's still in place. Mm-hmm. Even the penalty for not having health insurance is still in place for 2018, but this law eliminates that penalty after 2018.
Okay. Well, this has been great information for, hopefully our listeners out there doing their taxes or working with their CPA to do their taxes, have armed themselves with some good information to know what to expect.
Try to have a better understanding of a very complex topic.
Exactly, yeah. And if anyone, wants to get a hold of you, I know I asked you the same question last year. A, do you want them to get a hold of you? Because I know this is your super busy time of the year. And B, if you do want anyone to contact you, what would be the best way to do it?
The phone at my office is 616-456-6464, and my email address is dculver@culvercpagroup.com.
Okay, great. Well, Duane, thanks so much for sharing this information with us. You've certainly helped make it a little more clear to me. I mean, this is complex stuff to understand, and you know it so well, but to people like myself, it's it's like learning Hebrew or something. So thanks for taking the time to explain it.
You're welcome. Thanks for having me, Brian.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.